Hey everyone, as I frequently highlight in my videos, commercial real estate is a long-term investment with hold periods that usually range between 5 and 10 years. So I looked back at the last 5 years to see how 5 different property types performed. Now, the last 5 years have been particularly challenging from a real estate perspective. We had the COVID pandemic with the ensuing shutdown and record low interest rates. Demographics have also changed dramatically with millennials entering their 40s, and we've experienced the broadened adoption of remote and hybrid work models. On top of that, we've experienced a 50-year high run of inflation and a 500 basis point interest rate surge. So it's almost as if we've navigated an entire real estate cycle in just a few years. For the commercial real estate perspective, I'll start with office. The last 5 years have been really hard on office properties. The average vacancy rate in the second quarter of 2019 was 12.3%, and today, the office vacancy rate stands 490 basis points higher at a record high 17.2%. That, of course, reflects changing behavior and the adoption of remote work, which has reduced office space demand. As I've noted in other videos, this has really affected large, older, urban office buildings in major metros far more than smaller, newer, suburban office properties in secondary and tertiary markets. Looking at prices, over the last 5 years, the office property price per foot has fallen by 10% on an inflation-adjusted basis. Next up, apartments. The average apartment vacancy rate fell to an all-time low 2.5% in the first quarter of 2022. Then it rebounded to 5.8% as of the second quarter this year. The bulk of the rise in the average vacancy was driven by new development, with over 1.8 million new units added over the last 5 years. But we also had 3 quarters of negative absorption in 2022 as household formation stalled in the face of surging inflation and expectations of an impending recession. From a pricing perspective, apartments increased from 2019 through 2022 before values began to decline in the face of the interest rate surge. As of the second quarter this year, the average apartment price per unit stood 3.3% higher than 5 years ago on an inflation-adjusted basis. The industrial property story is quite similar to apartments, with the vacancy rate reaching a record low 3.6% in 2022, followed by a new supply-driven vacancy rise. In the last 5 years, about 1.9 billion square feet of industrial space has been added, with nearly half of that additional space being delivered in just 10 metros. Industrial property average prices have increased the most, up by 32.8% on an inflation-adjusted basis since the second quarter of 2019. And like apartments, the gains were achieved between 2019 and 2022. Since then, prices have slid, but not by as much as most other property types. Now, I'll focus on self-storage. Unlike other property types, storage got a significant demand boost from the pandemic. From the second quarter of 2019 to the second quarter of 2021, the vacancy rate fell by 350 basis points to a record low 5.5%. Since then, a combination of new supply additions and softening demand has pushed the vacancy rate back up to 8.9% as of the second quarter this year. It's nearly back to the 9% mark it was at in the second quarter of 2019. On an inflation-adjusted basis, self-storage values are 10.4% higher than they were in 2019, and the pricing trends align with apartments and industrial properties. They peaked in 2022 and have since come down under the pressure of elevated financing rates. The last property type I'll focus on is multi-tenant retail. From a vacancy standpoint, retail performed very differently than the other property types. It was almost the inverse of self-storage, as the pandemic weighed on the retail sector, especially service categories like bars and restaurants. The average multi-tenant retail vacancy rate peaked in 2021 at 6.2%, but it has since come down to 5.1% in the second quarter of 2024. A key contributor to the performance of multi-tenant retail has been the very limited construction over the last 5 years, with only about 74 million square feet being added. From a pricing standpoint, multi-tenant retail now stands about 5% below where it was in 2019 on an inflation-adjusted basis. So, looking forward, the prospect of a soft landing and impending interest rate cuts offers a promising outlook. Numerous key commercial real estate drivers like job creation and retail sales remain positive, and new supply risks have diminished for most property types in most markets. Given how well commercial real estate performed through the particularly tumultuous last 5 years, I anticipate a promising outlook. Think about it for a moment. Despite a global pandemic, the worst bout of inflation in 50 years, and a 500 basis point surge in interest rates, most commercial real estate is still ahead. What's that mean for the next 5 years? At the end of the day, that's what commercial real estate investors need to focus on, the next 5 years. As always, we need to keep our eyes on the horizon.